TGIF Warriors, who's ready for the NFP? Traded live here on F.A.C.E. Everyone ready for this? The Japanese are going to make NFPs irrelevant. I read today that whoever thought that Treasuries would become part of a trade deal. So every country is going to use their leverage. They own $1 trillion in Treasuries. That's part of their trade negotiations right now. That could overwhelm any kind of economic news. We already have issues with supply, right? So that's with absorbing new supply, not talking about supply that's, in somebody's treasury that they could liquidate. Just something to think about. Until I read that, you think trade or you think of goods, right? You don't think of financial instruments. Pretty interesting, huh? How you doing, RJ? Mike, Steve, how you, Blake, Kman, AJ, Ingmar,
Morning,
hi,
Coach.
Bran, Paul, hey, Blake, Kyle Barnum, you're new, aren't you? Nice to meet you. Okay, need to place my guess. Oh, go ahead, get your bets down, everybody.
Win a free month of Forex Analytics.
Yeah.
Put in your NFP guesses. Coach, what are you guessing today? What is your number?
Two plus 200,000.
Plus 200,000. I think I put in plus 77,000, I think. What'd you put in, Kman?
1,000.
One. Damn. Damn. That's brutal.
He's long some bonds.
Well, actually, Dale, I mean, it's something not to be proud of, because I told you, right, that I was getting very hot in trying to buy bonds.
Yeah.
Did not press that button because I thought we would have that one leg lower, and we didn't get it. So yeah,
We might still get it.
Yeah, we might. Obviously, we might still get it. We
You know
might.
what bothers me is this is when the Fed came in and said they're providing liquidity. Okay. This was a flight to quality rally. It wasn't anything it was no Hollywood spectacular. And if we start taking out this 87, this is a big number. It's going to make or break, I think, the bond market. But look at all we did was rally back to 61.8. Okay, and we're on the verge of turning lower on the week. So not how it reacts to the number, but how it finishes today, I think will cast a die in the bonds. And, you could call it maybe like a flag if it breaks down here. And this is a 9-handle decline. That'll give you 78. And, I just keep looking at the weekly and go, what's it going to take? It's really been a comatose market. So, I mean, people may feel great that they didn't lose money in, some of these tech stocks, but man, I knew bond bulls all the way from back here before they bottomed, and if they're still holding, guys like Harry Dent and everyone, because they're looking for deflation. Um, what's it waiting for? I guess so. We'll see. We're unchanged on the week. Under 85, you could get real negative. All right, you could call this a 15 handle, um, uh, a 15 handle formation that's going to give you 70, which is going to take out this October 23 low by plenty. But just a measured move off the flag's going to retest the lows if we break it. So I think that's the most important market to be watching now is, the Cent said it, right? So, the 10-year, that's what they're working on. So we'll see what happens. If Japan starts liquidating because they don't like the deal, although I think that there's, it's not hostile between Japan and the current administration. That's a lot of inventory. And I think about it, maybe Kman can help me with this answer, or Blake. And I'm wondering, we had this nice bounce in the end, right, from major support, and I believe that's all it is, and that eventually we're going to take out 140, may hold 38 and bounce again, but this is not a bullish formation. Eventually, they're going to, knock on the seller door once, knock on the seller door twice. Eventually, the cellar door is going to open. So
Before Kman answers, I do think and I will show it. The COT chart that he brought up, was it yesterday, Kman, or is it 2 days ago? I think that's
yesterday.
Yeah, that's a big deal. I mean, it's a big deal near term. So anyway, why don't you answer, Dale, and then I'll show that chart in a little bit if you guys missed it yesterday.
Would the yen continuing to strengthen, does that give them more motivation, even if there wasn't a trade friction, to be liquidating U.S. Treasuries because they're losing value in yen terms?
That's always a good question to ask when you look at Japanese investors. The thing is, they have their own rules of investing, and bear in mind that they also gave out a lot to manage to foreign asset managers, not only running their books their own. Like for instance, BlackRock is running a fair bit of GPIF's funds as well. So they will always manage it within a benchmark ranges that they have put. What there is that they can decide to change the hedges. Like for instance, if you go completely unhedged into US bonds, you actually just buy dollar yen and then you buy the dollar bond, right?
Right.
But if and that is usually a negative yen fact because they just buy dollar yen, those guys. And but the thing is, if they decide that there is enough uncertainty right now to up those hedges to the top end of what they put as their own range, that would actually be positive yen, because then you take away the negative effect on the yen by hedging your whole bond buying thing. Now, are they close to do it because of the yen? I'm not so sure. For the time being, they talk in yen terms, rather the effect that the yen has on prices. And that also came out of the Bank of Japan yesterday. So I'm not sure. It's not going to be a 2, 3, 4% move that is going to change their opinion, I think, about bonds. But the actual negotiations may do something. I think it is the attempt of Japan to get back in front of the US instead of being below them or on the same level playing, because the US is trying to push for a lot of things, but then they should realize, and they do. I mean, a guy like Besant is not is not stupid. He knows that Japan is the biggest foreign investor in US treasuries, right? And I think it may be a fair assumption that perhaps the US may weaken their stance a little bit if they hear that message from Japan. Japan is actually having been pretty well, hard lined is a big word, because you then on the other side you see a lot of investment projects in the US as well from Japanese companies, but they have been on the trade negotiation of things pretty hard lined, I must say. But for as long as
they have sold bonds, and because I read an
yes, they
article
did.
that Trump was upset with them selling bonds.
Yes, they did.
Okay.
They did actually in the turn over March and April. But they were at the end of their fiscal year as well, and then there was this uncertainty about what Trump was going to do over the tariffs. Now, if they go right into a frontal trade war with Japan, the US, I mean, yeah, then there could be a case of Japan getting out of some at least. But if we see the amount that they have sold in the global context, or in the global amount that they have invested in the US, percentage-wise, it was still very, very low, right?
Okay. What about the yen itself here, Kay? This was the target I had.
Yeah,
So
yeah. I mean, very good. By the way, I say I this morning already. I was thinking about congratulating you on that target. It's really nice. Yes, there is. Now a lot depends on, of course, the jobs report, whether it be for
yeah,
the dollar as such related or also for risk. We know that the Japanese yen is also a risk pair. We have seen the Japanese the crosses being very big, but now they are coming back because there is a risk that it's a finally all those layoffs will start to show up in the jobs report, and that we
okay,
get a very negative report. So people are selling back off a little bit of risk. Not that we've seen it in the stock futures, but in FX at least it has been the case. So yeah, I think it's all in preparation of. I would still say that if these job reports defies the laws of gravity, dollar and crosses yen may resume their upside a bit, because there's probably still a lot of people long yen as well. And if you are positive risk, if you get a good report for stock markets and stuff, you don't need hedges versus bad thing, right?
yeah.
Yeah, and
So
the trade
go ahead. I'm sorry.
and the trade relationship is something that's not going to be resolved today, huh? To,
Yeah.
uh,
Well,
it
who
is something
knows?
that we need to pick up again once we know how the discussions go.
Average length of a trade deal is to get it done is 2 years.
I
So
think with
there.
Japan is going to be much faster.
Well,
Japan will
I
be
mean,
one of
it
those where it's
has to
going to be
be.
much faster.
It has to be.
Yes,
I'm
because they
just
don't
saying
only
that.
have.
I'm just saying that under normal circumstances, that's how long it would take.
Yeah,
So
but because
I,
let's also not forget that.
they must be doing crystal meth,
Yeah,
staying
but.
up all night.
Mm.
What I'm
That's it,
conflict.
Dale. You got it.
You
But
know,
That's
let's
it. You
just
got it.
let's
yeah,
also not forget that they have a military cooperation. That's also one of the reasons why I think the US needs Japan as a buffer in Asia.
mhm, yeah. So the yen reached the target, but I'm still looking for I thought we'd get to par and a half to to 140. Um, this doesn't look complete to me. I'm thinking about just you know before the number, maybe just buying it and looking for this. Anyway, but this is, in my view, wherever it ends, it's a bear market. It's a counter trend move, and I do think there's going to be another low. So, if I
So,
miss this last leg up, the next step would be to start shorting the dollar up there.
so Dale, can I show
No,
that
yeah,
chart again,
go
Dale?
ahead. Yeah,
Oh,
go
okay.
ahead.
Yeah. Just on just since you guys are talking about the yen, this is the big commitment of traders chart that
Wow.
yeah, I mean, that is the largest amount of fast money traders ever, ever in the
Long.
history of commitment of traders going basically long yen.
Yeah,
So the problem with that is everybody is expecting, the dollar yen to drop through 140, in which you just
yeah,
you just showed that chart, which is, perfectly, I think, perfectly drawn. When because we talked about it on the week ahead video 2 weeks ago, I think it was 3 weeks ago. It was like my play of the day, if or one of the plays of the week, excuse me, is if this actually broke, but we didn't. I was gonna short it below 139.50. It just never did. So that setup is real, but here we are today, and you were pointing out maybe it could get to 150. I think that's possible, especially if you see some of this unwind. It's pretty common, Dale. We've seen it like the last I don't know, 2 years. Everybody bets against the U.S. labor force. Now we know that obviously a slowdown's probably coming, and there's gonna since this report is just before Liberation Day, before the tariffs were all announced. We'll see the fallout of the jobs report. We're going to see the fallout of the jobs report next month. Next month's going to be really important. But a lot of people were thinking, hey, maybe we're going to see some massive we were going to see job losses coming into this number. But people have been betting against the U.S. labor market for ages. I mean, we've sat here for 2 years going, man, it's got to start to weaken at some point, and it hasn't. So, I mean, if this is a strong number today, which obviously, as Kman's pointed out, everybody's leaning into the dollar this morning. Everybody. I mean, you look at the euro, you got the yen. I mean, everybody's leaning into this number. If this number is a good number, like a decent number, let's just say it's over 100,000 jobs. I think the dollar yen's right back at the highs and maybe towards 147. What are your thoughts there, Dale?
That was my target. I'm out. So I don't know what to do with the yen right now.
Yeah.
If I was aggressive, I would have shorted it against the target. But, NFP, I didn't do anything. I'm not sure what to do today. Maybe
Right.
it'll come to me.
Supposed to be a big report. Everybody's looking at it. So I think a bit of caution is warranted now, and let the interpretation of the big boys guide us as well. I've said it on the Flow Show, so I'm going to repeat it here as well. There's one thing that Powell is watching, and he hasn't really spoken about it on the last couple of meetings, but he does repeat it on the FOMC meetings. He has been repeating it for a while. It's something that is not shown on the free calendars. It is the total of the unemployed people, and he's watching the ratio that it has versus the JOLTS job openings, and if that thing turns sub 1, he may all of a sudden start to change his rhetoric. So that is something that I'm going to watch. I hopefully see those BLS reports relatively quickly. The last JOLTS opening number were, I think, 7,192,000, and the last unemployed report in March on the table was 7,083. So it's going to take what, 110,000 more or so to get unemployed for this number to turn subpar, and that may trigger a change in rhetoric from the man himself, Mr. Powell.
That's something important to pay attention to. That I'm sure Kman, as the data comes out, I'm sure he'll be running through that data, and report back to you what he's thinking here. I want to ask you, Kman, just since we were talking about the commitment of traders, this is going to come out today, and I'm assuming this green line is going to
numbers,
be.
huh?
It should be down a little bit. Yeah, the fresh numbers, it'll be from Tuesday. I'm assuming some people got squeezed out this week, even earlier this week as the dollar yen pivoted off of the 140 level. You probably should
really
see
don't
that
know
come
if
down.
that number is going to show it, because it was pre-Bank of Japan as well, right? And some people may have held on to those positions into the Bank of Japan.
Yeah. I mean, who knows? I mean, you like to think hedge fund managers are smart, but that doesn't necessarily, ring true all the time.
But they are players. Huh?
They are. They're like that's exactly right. I'm gonna bet on black and let's see what happens for the BOJ. And then they're like, oh shit, after the fact. So it'll be interesting to watch these numbers. I think it's important because, like I said, if we have a strong jobs report, if if yields continue to rally, you're gonna see this dollar yen continue to push up a little bit.
Most people are dovish on rates that I've been talking to. I don't really hear too many interest rate bears that are looking for higher yields. Have you?
Right, which would just fuel the fire again if yields continue to if yields bounce from here and they start to go up from here, that would be interesting, right?
Yeah.
So anyway, hey, we got about 10 minutes. I just want to mention something really quick, guys. Since you guys are all here, we have our liberation offer for Forex Analytics. If you guys haven't taken advantage of it, we've knocked back our prices about 5 years. We're letting people lock in monthly, memberships at about $3 a day. It's like $85 a month or something. So we are doing that specifically, because we know prices are going to be going up. If you want to be involved in the most active trading community, this is like if you want to see that I got actually limited in to the dollar yen overnight. I run, even though I was flat, I up until sometime in the night, I got limited in at 144.50. But if you want to know what positions I'm in, or Kman's in, or all these other traders, what we're doing, or having, conversations with us, talking about, what we think is moving in the market, and these are conversations that, shoot, I got up about an hour and a half ago, somewhere around here, when I said good morning. You can just see, just in our general chat room, these are traders talking about what's happening in the markets, how they're seeing it. And this is a Friday before non-farm payroll. Everybody's very quiet. Usually this is just bustling with comments over these time frames. So if you want to be involved in one of the greatest trading communities ever, take advantage of the liberation offer, and you get this great tool here. So Dale, let's talk really quick, and Kman, I want to come over to you in a minute. And I see, I think Steve had to leave. Steve's not here, so it's just the three of us. Dale, how are you going to trade today? Because I'm going to tell you guys how I'm going to trade today with the euro in just a few minutes, but how are you going to do it?
I may not trade today.
Okay,
So I mean,
capital preservation, right?
well, no, I mean, I had conviction. One of my trades hit target. I'm still holding some long dollars with, tucked in the stops, and gonna see what the number brings. If we have a strong number, then only a couple days away from taking the trade from the other side and shorting dollar strength, because I think there's gonna be one more decline, but I think there still could be, we still could see 101.40 in the Dixie before that happens. So that's why I'm playing it here. And I'm also short bonds. I'm in a lot of bond puts right now. I feel like that's a contrarian position, because people are kind of proud that they're in the bond market now. It makes them seem like, well, we missed the risk off in the market, which who knows if they did or they didn't. But people feel less stress about saying they're bullish bonds than bullish the market right now. Do you sense that too?
Yeah, I do. It's interesting. This is another conversation. Maybe we'll save this for Monday, because I was talking to one of my buddies yesterday, and he was asking me about the bond market. He went to talk to his banker. They were talking about, getting long some 10-year. They don't want to be long any 30-year. Anyway,
Right.
but they had this really interesting product. And again, this is a Monday conversation. I just want to throw this out there. Because he's a private client for, one of the big banks. And so he's like, yeah, we have these like products where you can you buy a group of like these three tech stocks, like Apple, Amazon, whatever. I forget what the other one was. And then you get, if those stocks don't drop more than 30% in a quarter, you get paid 4% income. It's an income generating product.
Oh,
But if it goes up, and the stock goes up past past your entry point more than 10% or something like that, they pay you out your 4, and then they just take everything off the table. So it's a really interesting product. But we were talking about
yeah.
the bond market yesterday. The reason why I say that, and I was trying to figure out what the angle to the bank was, and I was like, oh, they're just, but
What's the
what the
catch?
angle? What's that?
What's the catch?
Well,
When did you lose
no,
everything?
and if it goes down, your interest accrues until the
Yeah.
stocks come back. And I was like,
You
it's a
know what
really
I mean?
interesting product. We'll talk about it on Monday, because
Yeah.
it's like, what are the banks devising here, and why are they doing it? Anyway, really interesting stuff. But Going back to your question, and then Kman, I got to come to you because I want to see how you're gonna trade this market today. So Dale, your question was, you don't think that people are really bullish the bond market here?
No,
Yeah,
people are more comfortable saying they're in bonds instead of the market right
yeah,
now.
yeah, I think so. That's definitely a defensive posture, and I don't think it's the wrong posture either. I
Okay.
mean, yeah, me
Yeah,
personally, I
well,
mean, the thing that would scare me the most, I think, about the bond market is if we do see a material weakness in, you know,
that was
in the
intervention
hard data
last
that's
week.
coming out.
That
Yeah,
was
like,
intervention that saved it last week when Powell came out and said, we'll provide liquidity when it bounced off TLT off 85 again.
yeah,
So they're defending, they're going to
And
try
then
and
you had
defend it.
and
Huh?
then you had the quarterly refunding agree plans, right?
QRA.
Which added a bit of oil to the fire.
Yeah.
Yeah. Yeah.
Hey,
Anyway, if you
so
covered up it looks like you had a straight line break, 61.8% rally back. Gotta take a trade like that, right or wrong. Just like you took the S&Ps at your
at the
resistance
618,
levels.
yeah,
Yeah, you
you got
still
it.
in it? You're
You got
still
to
in
take
it,
that.
right?
Yeah. Yep. Yep. Yep.
Okay. All right.
Hey, so K-Man, real quick, how are you going to trade today?
Okay. If it's really a bad one, I think stuff like euro is probably going to fly through the 114, 14 and a quarter. Um,
Why? Because everybody's leaning into this head and shoulder pattern right now.
Not really. Therefore, it's just that prior highs and the market, the bears in the dollar will have this bone in their mouth and they are going to chew it. I think that
Yeah.
um, of course it's already been partially prepared because we saw the dollar selling this morning. But I still think that if we get a confirmation that the employment market is slowing down, it's probably going to run right now. If we get a mildly positive report, that is, and I think we agree on the 100K number. Anything above 100K with not too much stress on the unemployment rate, etc. I think risk is going to do pretty well. That is stock market up and probably yen crosses, Swiss crosses back up as well as the dollar yen being supported. I'm not sure if the dollar is going to rally a lot versus the rest, but it's more, I'm going to take it as a bit of a risk trade. And obviously, if it defies all the laws of gravity and we get a bumper report 200 or above, and then with the employment rate even coming down, well then the dollar is probably going to hurt a few, I guess, because I don't think the market is fully prepared for a bumper report today.
Yeah, I agree with that. I totally agree with that, K-Man. And I'm and as far as let's say it's bad data, and the dollar does come under pressure. I'm with you on the euro. I actually have orders to sell the euro at 114. Now they're small, but I want that exposure just because I think that if the dollar, if the data is weak, we are going to see stocks come under pressure. So the initial response will be knee jerk to sell the dollar, but I think the dollar, this is the time that the dollar starts responding as more of a safe haven currency. So we've seen it time and time again. You get initial dollar, sell off, and then everybody goes, "Oh shit, I want to buy the dollar again." And so I think that because you're going to see yen pairs weaken, you'll see that euro yen weaken, and Aussie yen and stuff like that.
Here
So
we
that's
go.
how I want to play the euro is on weak data, and that I just want to be short euros a little bit
Depends.
higher.
Depends how
Now
weak
if
they
it's
are.
strong data, obviously I'm just going to chase the dollar yen higher.
Yeah,
That's the
that one.
play, right? So all right, guys. Well, we have data
Less
coming
than a
out
minute.
literally in about a minute.
Don't chase anything.
I'll only chase my tail sometimes, Dale. So so data's coming out. We don't have Canadian data today. I have the S&P to the left, Dollar index in the middle, 10-year yields over here to the right, all 15-minute charts, so you can see the intraday reaction. Data flash comes off of Forex Analytics. You can launch it in the calendar portion of Forex Analytics. It's a little pop out, so you can see that this data will come out about as fast as we can get it. So here we go.
177.
Wow.
I was pretty close.
Wow.
It's all okay.
See? All right, so now we got that dollar rally.
Average hourly earnings even came down.
Yeah, but only 0.1, you know. I mean, and it's the same as last month. So no dramas at all in this report.
I bought some dollar yen.
Payrolls lower, but not that much. No, it's
hourly work week, 34.3.
I don't think there's any dramas there.
No, I just bought some dollar yen, so I got some.
So let me ask you this: a pretty good jobs report. Do you think our president's going to take credit for a strong, strong jobs report?
Obviously, but then he will add. Then he will add.
I mean, you know, his policy has created a lot of jobs. Doge was a pretty big job producer.
Yeah, I mean,
Right?
but he's still going to ask for Powell to cut rates because that's his his line now, you know.
Yeah.
Good
So
or bad.
Paul's got cover, and you know what? We've got cover because we got Pedro da Costa here
Whoop.
to talk about the Fed and what he thinks is going to happen next week. How about
Yields
that for
ripping, yields ripping, stocks ripping, dollars, moving higher.
Rally.
Yeah. All right.
Get through 46.
We'll see, and we'll see. This S&P is going to be really interesting because we are up at the 618 retracement. Let's not forget this is a big resistance. But why? I mean, on good data, it's hard to short the stock market on good data. We could probably see this 200 DMA now. So, yeah, it's interesting.
I'm looking for equality. Blake, see that low from 48 to 55? That was A. Then the pullback where you bought it at 51 this week or last week, and tack on 800 to that, and you get 5,800, 5,900, 58, 5,900, 78.6 back is what the C wave, if it's equal to A, would take us to. Anyway,
sorry, Dale. I'm just looking at the market.
Oh, okay. Anyway,
I know we were engaged in a conversation, but I'm sorry. I was just looking at everything
go ahead,
going on.
Go concentrate, and everyone stick around for Pedro da Costa.
Yes.
Used to be Pedro would be at every Fed meeting. They bounced him out of there because his questions were too tough, and now they keep him locked up during Fed meetings, and he gives his associates.
He's an awesome guest to have here.
I'm still in there, Dale. I'm still in there. Don't worry.
Oh, they're still letting you in there now? The new administration?
No, it's not that. I'm in the. I'm in the building. I just don't go to the press conferences anymore.
Okay, that's what I mean.
It's more advantageous for my colleagues to ask questions.
I understand. It's great to hear your voice, Pedro. So this was NFP was a bit of a surprise to the upside. I don't think anything's going to give Jay cover from the president about lowering rates. What are your expectations now that we have this number and you saw some decent inflation numbers too? What's Powell going to say in the presser that you don't go to anymore?
What's he going to say in the presser? Well, he's gonna try not to make any news at all. And I think this reinforces their propensity to remain on hold. They almost have they're almost pre-committing to being late to the party this time, almost in the same way that they were to hiking rates, ironically, in the sense that they want to make sure that inflation expectations are well anchored because we're coming from a place of high inflation as this tariff shock hits. So that's a major concern as to whether, inflation might become entrenched from this shock. And so their tendency is to wait, really, really wait for the hard economic data to deteriorate meaning the employment and growth data, before they act. Now, we did get a negative GDP print yesterday, but there
Yeah.
are different ways to slice that number. And so I think that, it would be hard for us to see. We definitely don't have any reason, they don't see any reason to cut next week. And it's hard for them to get enough evidence by June even for them to have that. So we're looking really at the second half of the year for them to have any kind of sense of direction. And I'd point you even to, there was a market moving comment by Beth Hammock about the possibility of a June move. But just to emphasize, her media team like really pushed back on the idea that she was talking about a June move, and noted that she was actually trying to talk about the possibility that they could go in either direction once they have clarity. So I think markets are counting
Okay.
on rate cuts, but some Fed officials are still not even sure which way they're going to go.
Well, have you ever seen a time like this?
No, I certainly have not. I think one of the
Yeah.
things that, I was actually on Wall Street, uh, you know, visiting New York, meaning, because I'm based in DC, and I was in 2008 back during the financial crisis, and I happened to be visiting some of our subscribers in sort of the worst days of the volatility, kind of the week after so-called Liberation Day.
Yeah.
And it was eerily reminiscent of 2008. And one of the curious things that struck me was that back in the global financial crisis, you had, a private sector crisis that, while we didn't know how it was going to get resolved, you kind of knew where to run. People knew that they could run to the bosom and comfort of the US government and US Treasuries, and that ultimately the Fed and the US government would figure a way out of things. But now that the crisis seems to be coming from the US government itself,
Yeah.
there's a sort of scrambling for alternatives as to where do we run and hide. And I think that's a really distinctive aspect of this crisis, or of this moment, I should say, that that we have yet to come to grips with. And I'll point out that people who had, very serious voices that I speak with in the central banking and kind of policy community, who until a few weeks ago would have never entertained the idea of the dollar losing its reserve status, are now talking about it as a kind of serious possibility. So there's been a huge
Shift.
shift in mindset.
Okay. All right. I think the center of the hurricane is the bond market. And I'm not the only one who thinks so, because this day right here, Pedro, was the day that Powell came in. Bonds were still selling off, even though the market was selling off to new lows at the same time. And they
Yeah.
said it was some trade. It was just forced liquidation of a
Yeah.
basis point trade. Do you believe that was the whole reason for this break?
I'm not sure. I mean, I think the data, from what I've read, the data that came out afterward did not quite bear that out.
Yeah,
And there was evidence of official, selling of holdings as well. So I think there was
okay.
a big mix of factors that I mean, the benign story that I've heard, and so I interviewed Tobias Adrian, who's a former New York Fed markets desk guy who now works at the IMF. He releases the Global Financial Stability Report
Mhm.
during the IMF meetings a couple of weeks ago. And so his point was that we had, as you know all too well, given your neck of the woods, we had been in this hyper US exceptionalism trade that had just supercharged dollar assets. And so you could
Mhm.
see this trade as kind of taking the edge off of that extreme. So that's the benign interpretation, but there's also the sense that there's been a loss of trust in terms of the US as a geopolitical ally and as a trade partner, and just as a reliable implementer of economic policies. I think it's more the way that these things have been rolled out rather than the policies themselves.
Yeah.
And so that concern about the reliability of the United States as the world's largest economy, I think, is an important shift in how investors are preparing themselves
Yeah.
for the future.
When you say the community, the trading community, the advisory community, feel more after, especially after the sell-off of 20% in S&Ps and more in NASDAQ, more comfortable representing themselves as bondholders than stockholders, which implies that perhaps they missed a drawdown of the stock market sell-off. Do you hear a lot of people talking more doves about rates as far as where people think they're heading than people thinking they could head sharply higher?
Uh, I think that has been in terms of the market consensus or in
Yeah,
terms of policymakers. The
both.
market, so I would say it's a little bit, there's a little bit of a divergence, and there has been this whole cycle. And so with the market participants, it's a little hard to discern what is their desire from what their preferred policy path. You know what I mean? Like
Yeah,
it's like they're begging for rate cuts. They want the market wants rate cuts. The market almost needs easier conditions in order to sustain kind of its levels in any way. And so for market participants, they've always gotten a little bit of ahead of their skis in terms of expecting the market, the Fed to cut. In terms of the central banking community, there are a lot of really intelligent folks out there who in the past have been very dovish voices, who now are looking at this from a very different perspective, and who think that you just can't ignore the inflation side of the mandate when you're coming at it from, an inflation rate that was already stubborn before a tariff
right.
shock.
Yeah,
And you have this debate where Waller is talking about the possibility that they might have to cut rates when inflation is actually ticking up to 3-4%. And I just don't see Chair Powell as a kind of a lame duck chairman whose term is probably going to be over in less than a year, getting enough consensus around the table to cut rates in that environment. So therein lies the difficulty.
and
And
you know,
then you have
Pedro,
go
go
ahead.
ahead. No, go
No,
ahead.
I think you have the issue, the political pressure that's been brought to bear on the Fed kind of makes
Yeah,
the job harder as well. I think Powell
yeah,
does see his institutional legacy as defending the Fed's
yeah,
independence from any attacks. And
yeah.
so that kind of further decreases his potential tendency to want to cut rates.
Okay.
And I don't think
And
that fight's going away, by the way. I think, people think that, the president backed off of Jay Powell, but he did so for now. But let's say that like inflation rises to 3.5 and Powell starts to intimate the possibility of rate hikes. Can you imagine what happens then?
yeah, or the market taking out the early April low.
Yeah.
And that, there again, the president could say it's because always, always a little late, Paul. Is that his nickname?
It was too late. I think it was too late. If I could say
Too,
one more thing, actually, which I think is really important. You mentioned the bond market. I think
yeah,
there's something really dangerous that just happened is there's been this whole talk about what the Trump put is and is, we used to think it was the stock market and Trump
right,
won. Now it's the bond market and Trump two.
right,
And so now the bond market has this renewed sense of confidence where it thinks it can control Donald Trump. I don't think anybody can control Donald Trump, to be honest. And so
right.
I think it's a dangerous illusion for the bond market to think that just because the 10-year yield breaks above a certain level, that the president is going to change his mind on policies that are near and dear to his heart.
Oh, that's a great point. And can you explain to me what the Treasury Secretary was talking about last week when he talked about a facility for the Treasury to come in and be bond buyers? I took it as, what are they worried about? I, you know,
No,
because
yeah,
what do you think? I
I
mean,
don't know. We were wondering the same. We were wondering what exact facility he
I'll
means.
tell you what they're worried about: a straight line break, a panic low with only a 61.8% recovery, when I'm sure they threw a ton of ammunition at this market right here, and all they did was generate a bear market rally, and we're going to break down. And if I was the Treasury Secretary, they better defend this 85 level right here, 85. This was the test, 85. You can't keep knocking it on the cellar door without falling into the cellar. So, I'm thinking one more attack at 85, and that measures underneath, Pedro, the October 23 lows.
Yeah. Well, there is this sense that there is this sense in the market that despite kind of lip service to deficit reduction, there's not going to be much of it, right? And that the tax cut renewal is going to blow out the deficit in a very significant way. And so there's this weird kind of market echo about the possibility that a future Fed chair that is more acquiescent to Donald Trump would just come back and do QE again, right? Just to actively finance the debt. So I think there is this underlying fear in the markets. One problem with that is that neither of the leading candidates for Fed chair would, from all that I know reporting on them for years, would be on board with that. In fact, I don't think either Chris Waller or Kevin Warsh is very big on the use of the balance sheet for stimulus purposes, and certainly not for financing the deficit. In fact, they want to go in the opposite direction. So it remains to be seen.
Austerity that Americans don't know the definition of.
Right, austerity at a time where we might be already under the cloud of an economic shock. So so it could be austerity at the wrong at a sort of pro-cyclical time, which is
I found interesting that part of you think of trade wars and negotiations, and you think of what's coming over on the big ships, the big container ships bringing goods to the U.S. I really didn't think about how a financial asset, like the Japanese are saying, that of course their $1 trillion holding of U.S. Treasuries is part of the trade negotiations.
Yeah, isn't it amazing though? But it's one thing for it to be so implicitly. It's another thing for the finance ministers to state it publicly, right? That shows you the extent to which we probably have ticked them off, because we have a pretty good relationship with Japan, and so it was a very significant statement to hear. For sure.
Yeah. So biggest story of the next quarter, 90 days. My bet, I'm hearing things like China's ready to negotiate. I think they hold out through the whole 90-day period and without giving a deal to Trump, because they're going to let him fall on his sword. And I think by then we're going to start to have some empty shelves. What about you, Pedro?
I am concerned about that. I'm hearing about that possibility from people who are smarter than me and who understand global supply chains better than I do, and including from people who are on the ground. The chief of the port of LA talking about 35% decline in volumes, the kind of numbers that we heard during COVID, even though it's a different kind of shock.
Right.
And so I'm definitely concerned about that. And so that's why it's so difficult to discern the inflationary shock from the disinflationary one, and why they might have to coexist in a terrible way, because if things go missing, the price is going to skyrocket, even if the economy is going to a rut.
Yeah, people are worried about only the price aspect of it, not thinking about the availability aspect of things. I mean, if I can't get simply watermelon juice because, they're not stocking it anymore, I don't know what I'll drink during the day.
Tell me about it. And to your point,
Dale, I've already noticed it at stores. They're already having stocking issues.
Yeah. And prices are definitely going up. I'll give you an example. I bought a suit, and then the jacket was, buying suits online is never a great idea because it's not going to fit right. So jacket was a little small. I had to buy the bigger size. I went to buy the bigger size. It was $50 more. like 2 days later, and it was right after tariff day.
Okay. All right. Well,
we're definitely heading in that direction, and it's a kind of a dangerous moment. So
all right. Well, thanks for helping us keep our heads about us. I think it's going to be real important to follow Pedro's writing and the other people at MNI, where you could really educate yourself about what's going on, and with the demeanor that's calm but resolute. I like your resolute as a combination of you being resolute about what you say, Pedro, and not being real emotional about saying it. It's almost like it's a matter of fact.
Oh, I
So
appreciate that. That comes with age. I was way more
yeah,
I was way more
don't
emotional about things in my
don't
youth, but I've
yeah
learned to control it.
yeah don't remind me. But anyway, I think the surprise is everyone's worried about a stock crash. I think they better be worried about uh, maybe the Treasuries being the problem.
That's
I think
definitely the market that I would watch.
yeah. I mean, look, under this administration, maybe we'll have a default. There are other things that are going on. You know, we could have, when they go to the last day to fund the government, that these things are. It's possible that everyone always says, "Oh, it's all theater." One time it may not be, and in this environment. They say in a bull market, everything that could go wrong doesn't, and in a bear market, anything that could go wrong does. So
And I
look,
find it so interesting that there's so much optimism still out there. The market's been kind of
yeah,
smacked around a few times, and it's still like, oh, but we're fine. We're bouncing right back. And to your point about trade deals, trade deals usually, I've heard this statistic over and over from people who negotiate these deals. They take at least 18 months or more to negotiate.
right,
90 days is nothing. So
yeah,
you might come up with a couple of random deals, but how much are they going to be,
it's
worth their
impossible.
salt underneath? And how long are they going to hold, considering that, the first USMCA was signed under Trump 1 and it's been reneged upon just a few years later.
Yeah, so it's just another piece of paper until the mood changes.
Oh, I
Okay,
should
so
I should mention, if I could mention one thing, I don't want to hog
no,
the
go
mic
ahead.
here, but I did speak to Stephen Moran yesterday, the White House chair of Council of Economic Advisors.
Wow,
And what was interesting is there's a fear in the market about, like, once they're done with tariffs, they're going to go to a Mar-a-Lago Accord, and then they're going to impose a user fee on treasuries, and they're going to extend maturities. I don't know if you saw that FT story that had a discussion between hedge fund managers and Moran that did not go very well, apparently. And
yeah,
but his point to me is that these musings that he wrote in a paper last year were just that, and that's not an explicit part of the Trump agenda, and people shouldn't interpret it as such. So I found that to be pretty interesting.
thank you for sharing that with our community and everything else you do, Pedro. Look forward to our discussions. I just want to show people before you go how they would, get to your site and
Yes,
where they could.
our new URL is mnimarkets.com.
Okay, I'm going to pull. So at the minimum, follow
Oh yeah,
Pedro on X.
I need to change the URL there because that's the old one, but it still goes there. So
Okay, and here's MNI.
that's,
It's a great resource. And are you under policy
yeah,
or
that's it.
global?
Under
Yeah.
policy, that's us.
So under policy, you find Pedro.
Developed markets, and that's all our stuff.
Yeah. And I mean, they have a huge crew. They have a lot of people
But we also
that
have a
cover.
strong paywall, so you got to pay up. But you can easily get a trial, and it's honestly a pretty. I'm not in sales, but it's a pretty amazing service, which includes not just our news coverage of of policy events in DC and all over the world, but also, like, on the market side, some really in-depth market analysis across asset classes. So
Okay. And if you're a youngster, boy, would it be great to get a job being a young person at an organization like this. It'd be like, getting a job at Barron's 21st Century.
that's exactly right. It's such
Yeah,
a cool place to work. It's such a
yeah,
positive environment. It's
yeah.
really, really cool.
Financial journalism it's not the trading floor, but I guarantee you there's lots of trading of ideas there. So I'm not
Exactly.
a recruiter. I just was curious. So Pedro DaCosta, thanks so much for being here. We have to pay attention to the bond market. I do think though, Pedro, I would like to see the market go through one more cleanse and take out the April low before it turns. That there is a chance in the second half of the year that we have a pretty strong market. I mean, this what has been a strong recovery
Yeah,
from that 4,800 level. But you know what people have to understand is the market isn't the economy.
absolutely.
Not, it's a financial asset that could be manipulated. That's what I've learned. It took me. I didn't believe the manipulated part to the extreme, but that's what it is. It's just another asset that could, have its value blown up to amazing heights or deflate to amazing lows.
And boy, are we seeing that in real time right now.
Yeah, real estate, I think that's at it. I think, in fact, I know one of my sources believes that this housing crisis will be worse than '08.
Fascinating.
Yeah. So,
Phew.
we got a lot on our plate going forward here over the next 4 years, don't we? And it's also like the last, if you read the fourth turning, um, this turning completes into 2030. So, and I think it's a 20-year cycle. So we're entering the final stages of that. We're going to see a lot of history, Pedro. Um, I hope people believe in more than money going into this.
Well said.
Okay, so, um, I look forward to talking to you in the summer, buddy. Keep up the great work. You're a watchman for the FinTwit community, because I know you mainly have institutional clients, but the retail guy, the guy that's trying to, navigate his way through markets, uh, you help them. Okay, so great mission. Pedro DaCosta, everyone follow him on X at P DaCosta, and we'll see what his commentary is after Jay next week. Thank you, Pedro.
Thank you so much for having me, Dale, and thanks everybody for tuning in.
All right. Great. Thanks for giving all these years coming in here. And so that's a wrap. TGIF, we made it. Another one in the books. I think we had a long USD yen bias, either against a dollar or in other pairs, yen pairs crosses. Had a pretty good week being long the dollar. And remember, this is just a bear market rally in the dollar in our view. I take what Pedro said. I concur. Um, the dollar's in trouble, but there'll be great entry. Be a nice short up there at 101.50, and then maybe another one later in the year at 105. But then after that, we correct this whole first wave down. Um, then we're talking about 80 if you're a dollar bear. Okay, so that's a wrap. Have a great weekend, everyone. I'll see you on Monday. Thanks again, Pedro.
Thank you.
Okay, see you guys, Simon, Adam. Yeah, yeah. Okay, people are thanking you.
I
All right,
appreciate it.
so have a great weekend, everyone. I'll see you later. Adios.